of the FASB as they make standards which become GAAP. We have a need for this conceptual framework to develop a coherent set of standards and rules and to solve new and emerging practical problems. So if we have this framework available, we can run through the framework and come out with a correct standard, as opposed to having 5 million things coming from different directions and we end up with standards that conflict with each other. It's important to have this framework so that it can lead to those consistent standards. Prescribes the nature, function, and limits of financial accounting and financial statements. According to the FASB Conceptual Framework, the objectives are based on the needs of the interested users, especially the investors and creditors. These are people outside of the company, and so they are not able to get information as quickly. So a company chooses an acceptable accounting method, the amount and types of information to disclose, the format in which to present it by determining which alternative provides the most useful information for decision-making purposes. So here again, the objectives or accounting should provide information that is useful to present and potential investors and creditors and other interested users. Helps present and potential investors and other users in assessing the amounts, timing, and uncertainty of possible cash receipts, such as dividends. So if you're thinking about investing in a company, one of the things that you're concerned about is, are they going to give me dividends? If so, how often and how much will those dividends be? It shows the accounting also should show the economic resources of the enterprise, that's the assets, the claims to those resources, that's the liabilities, and the effects of those transaction events and circumstances that change its resources and claims to those resources, including such things as revenues and expenses. Understandability. This is also listed in the framework. However, it's important enough to bring it up on its own right now. To understand financial statements and the standards that make us do the financial statements the way they are, we have to have a basic understanding. And the interested user has to make a basic understanding. So are we going to make the financial statement where a first grader could understand it, where a high school person could understand it, where only CPAs can understand it? Okay, so having a basic level of understandability of a person that should be able to understand it. And so it is assumed that the interested user would have at least a year of college accounting courses. They have the basics of knowing what is an asset, what is revenue, etc., and how they fit onto financial statements. Does that mean that since you are in Accounting 201, you've already had Accounting 101 and 102, that you're going to understand everything that's on General Motors financial statements? No, you will not, but you will understand the basics. You know that an income statement includes revenues and expenses, and you know what those things are. You know a balance sheet has assets and liabilities and owner's equity, that the assets need to equal the liabilities and owner's equity. You know what those things are. So you have that basic, the lowest level of understanding. And hopefully by the end of this year, you will have an even greater level of understanding. Now, there was a previous framework developed, and it had 3 levels. It had the basic objectives, which we've already talked about, the needs of the investors and creditors. And the qualitative characteristics, they had basic elements, and they had recognition and measurement concepts, were the third level. And so you would, as they considered something to be a new standard, to newly be part of GAAP, they went through these levels. Now they've changed the conceptual framework some, and now it's a little bit different. So the first level is called fundamental characteristics, and then enhancing characteristics, and then cost constraints. And many of the same characteristics that were already on the previous framework are used on the current framework. They're just kind of rearranged, and some are bundled together now that they were thought like, well, they're similar enough, let's just put these together, let's put this one over here, that kind of thing. But it's the same basic types of things, and it still remains that the primary objective is to be useful to investors and creditors. Here it shows you the previous conceptual framework for financial reporting. Here's the objectives. That's the first level there. Useful investment and credit decisions. Useful in assessing future cash flows. Okay. Here are this is the second level. The qualitative characteristics that we'll be talking about: relevance, reliability, comparability, consistency. And they also had these elements, which are basic things like assets, liabilities, revenues, expenses, etc., that we know about. And here's the third level, in which we have assumptions, principles, and constraints. Now the current one has just, in their third level, just has this cost, benefit, constraint. But these other things are kind of built in other places. So these things are still important, and we're still going to talk about them in this, in the PowerPoint. Here is a picture of the new one, and we've got decision usefulness of the financial information is the primary objective, as we already said. And we've got fundamental characteristics, which include relevance and faithful representation, and what is included in those. We have enhancing characteristics, which include these four things, and our one cost constraint. And so we're going to go through these, and then we'll also go through some of the other things that bear mentioning from the other